Alright, let's get right to it. You hear the term the Fed on the news all the time, and it sounds so official and complicated, doesn't it? Well, we are going to demystify it right here, right now. The Fed is simply short for the Federal Reserve System. Think of it as the central bank of the United States. It's not a regular bank where you go to open a savings account or get a car loan. No, this is the bank for other banks, and it's the bank for the US government itself. It was created by Congress way back in 1913 to create a safer, more flexible, and more stable financial system for our country. That was its goal then, and that is its goal today. Now you might be thinking, Suze, why should I care about some big old bank? I will tell you why you must care. The decisions made by the people at the Fed have a direct impact on your money. Yes, your money. The money you work so hard to earn, save, and invest. The Fed is designed to be independent. This means its decisions are supposed to be based on economic data and research, not on political pressure. This independence is crucial. It allows the Fed to make the tough, sometimes unpopular decisions needed to keep our economy on the right track for the long term. So, when you hear about the Fed, I want you to sit up and pay attention. The structure of the Fed can seem a little confusing, but let's break it down simply. It's made up of a few key parts. There is the Board of Governors in Washington, D.C., which is the main governing body. Then there are 12 regional Federal Reserve banks located in major cities across the country, like New York, Chicago, and San Francisco. These regional banks are the operating arms of the system, serving the banks in their specific districts. Together, this entire system works to oversee the nation's money. It's a big, important job, and understanding its basics is the first step to becoming the master of your own financial destiny. So, let's be clear. The Federal Reserve is not some scary, secret organization. It is a fundamental part of America's economic structure. Its main purpose is to look out for the health of the U.S. economy and your financial well-being, even if you don't see its actions directly every single day. Knowing what the Fed is, and that it stands for the Federal Reserve, is your first step. It is a powerful institution, but knowledge is also power. The more you know, the more you can understand the world of money, and the smarter you can be with your own financial choices. Now let's move on to what it actually does. So what does the Federal Reserve actually do all day? It's not as mysterious as it sounds. The Fed has three main goals, or what they call a dual mandate plus one. The first two parts of this mandate are the big ones, to promote maximum employment and to maintain stable prices. Maximum employment means they want as many people who want a job to have one. A strong job market is a sign of a healthy economy, and that is good for everyone. When businesses are hiring, people are earning, and that money flows through our communities, helping everyone prosper. The Fed uses its tools to create the economic conditions that encourage businesses to grow and hire more workers. The second part of that mandate is just as important: stable prices. What does that mean? It means fighting inflation. Inflation is when the price of everything, from your groceries to your gasoline to your rent, goes up over time, and your dollar buys less than it used to. A little bit of inflation is considered normal and healthy for an economy, but when it gets too high, it can be devastating to your savings and your budget. High inflation erodes the value of your hard-earned money. The Fed's job is to keep inflation in check, usually aiming for a target of around 2% per year. This keeps prices predictable and helps your money hold its value over the long run. The third major job of the Fed is to ensure the stability of the financial system. This is a big one. The Fed acts as a supervisor for the nation's largest banks. It makes sure they are playing by the rules and not taking on too much risk that could endanger the whole system. Think back to the financial crisis of 2008. The Fed stepped in to prevent a total collapse of the banking system. It serves as the lender of a last resort, providing emergency loans to banks when no one else will. This helps prevent financial panics and keeps the system that holds all our money safe and sound for all of us. So let's review. The Fed's three key responsibilities are helping people find jobs, keeping the prices you pay stable, and making sure our banks are safe. They manage these massive jobs by using their financial tools, which we will talk about next. They don't print money in the basement as some people joke. Instead, they influence the amount of money and credit available in the economy to achieve their goals. Understanding these jobs is critical. It shows you that the Fed isn't just an abstract idea. It has a very real mission that directly impacts the economic environment you live in every single day. Now we get to the part you have been waiting for. How does all this Fed talk actually affect you, your family, and your money? The connection is through something called interest rates. The Fed has a powerful tool called the federal funds rate. This is the interest rate that banks charge each other for overnight loans. You don't pay this rate directly, but listen to me closely. It influences almost every other interest rate in the economy. When the Fed raises or lowers this key rate, it creates a ripple effect that touches your finances in very real ways. This is the number one way the Fed's actions reach your front door. Let's look at an example. When the Fed wants to slow down the economy to fight inflation, it raises interest rates. Suddenly, it becomes more expensive for you to borrow money. The interest rate on your credit cards will likely go up. If you want to buy a new car, your auto loan will cost more each month. And most importantly, mortgage rates will rise, making it more expensive to buy a home. On the flip side, higher interest rates can be good for savers. The interest you earn on your high-yield savings accounts and certificates of deposit or CDs will also go up, meaning your savings can grow a little faster. Now, what happens when the Fed wants to stimulate the economy, perhaps during a recession? It will lower interest rates. This makes borrowing money cheaper. This encourages people and businesses to spend and invest. Your credit card rates might go down. A car loan becomes more affordable. Mortgage rates fall, making it a better time to buy a house or refinance your existing one. This is the Fed's way of giving the economy a little push to get it going again. So you see, whether you are a borrower or a saver, the Fed's interest rate decisions have a direct and powerful impact on the cost of your money. This is why you must pay attention to what the Fed is doing. It's not just for economists and Wall Street traders, it's for you. Understanding the direction of interest rates can help you make smarter financial decisions. It can help you decide when it might be a good time to take out a loan, or when it's a better time to focus on saving and investing. Knowing this information gives you power. It helps you plan and prepare, instead of just reacting to financial changes as they happen. You become an active participant in your financial life, not just a bystander. So we have learned a lot today. We've demystified what the Fed is, the Central Bank of the United States. We've talked about its three main jobs: keeping employment high, prices stable, and our banking system safe. And most importantly, we have connected the dots between the Fed's big decisions and your personal bank account. It is all about interest rates. The choices made in those big, formal meetings in Washington, D.C. ripple out across the country, affecting the cost of your mortgage, your car loan, and even the interest you earn on your savings. This is not complicated stuff when you break it down. It is real-world knowledge for your real-world life. I want to be very clear about one thing. This information is for your education only. It is not, and I repeat, not financial advice. I cannot tell you what to do with your money. My goal is to empower you with knowledge so that you can make your own strong, smart, and secure financial decisions. You are the one who is in control of your own destiny. Understanding how major forces like the Fed work is a huge part of being financially intelligent. It allows you to understand the headlines, to see the bigger picture, and to plan for your future with confidence and clarity. Knowledge is the ultimate tool for financial freedom. Ultimately, being informed about the economy is no different than being informed about your health. You need to understand the basics to take care of yourself properly. The Fed is a basic, fundamental part of our country's financial health. By understanding its role, you are taking a massive step toward financial literacy. You can now listen to the news, and when they say, the Fed is expected to raise rates, you will know exactly what that means for you and your family. You will be ahead of the game, and that is where you always want to be when it comes to your money. Let's end with this. The Federal Reserve is a powerful institution, but you are more powerful than you think. Your power comes from your knowledge and the actions you take. So, keep learning, keep asking questions, keep striving to understand the world of money. If you found this helpful, I encourage you to share it with someone you care about. A conversation about money is a conversation about life. The more we all know, the stronger we all become. You can do this. You have what it takes to be the master of your money. Now go out there and be strong, proud, and secure.